Hey everybody, my name is Kevin Nunez, founder of NJK Partners, and welcome to another episode of Invested in Us, where we explain money the way it should have been explained to us. So friends, as of Friday, January 30th, the S&P 500 was up just about 1.5%. Remember friends, the S&P 500 is America's 500 largest companies, and this is the index that most people point to when they're referring to the broader stock market. Now, something that was noticeable was the Russell 2000. It actually had its worst week since October. Remember friends, the Russell 2000 are 2,000 of America's smaller companies. We call it small cap companies. Typically, they have a valuation of between $1 and $10 billion. So although the Russell 2000 had a rough week last week, it's actually up on the year over 5%, significantly outperforming the S&P 500. If we double click on the S&P 500 sectors, you'll see that telecom, communications, and energy sectors have significantly outperformed the other subsectors. That's important to highlight because if you've been following the content, we've been bullish on real assets. When I think of real assets, I think of anything you can touch. That goes from energy markets, which include midstream energy. That goes to the real estate markets. We're talking infrastructure. Of course, we're talking precious metals such as gold and silver. So real assets can really run the gamut. So as of last Friday, the 10-year treasury ended around 4.22. That's important to highlight because that's crept up from the low fours recently. Why is that important to highlight? Well, your mortgage rates, your car loans, your credit card interest rates usually are based off of the 10-year. And when the 10-year interest rate increases, you could expect mortgage rates, car loans, and credit card rates to simultaneously creep up. So friends, from a policy and economic standpoint, last week, the current administration nominated Kevin Walsh to serve as the president of the Central Federal Reserve Bank. This is important for several reasons because the central banks are the ones who set the policy of how much money is in or out of the system, and they also control interest rates. Central banks have tools at their disposal to help them manage their two mandates. Their first mandate is to make sure Americans remain fully employed. It's to make sure unemployment doesn't creep up. Their second mandate is to make sure inflation doesn't run away from them. They don't want a gallon of milk being $5 today, $1,000 tomorrow, and then $5 the day after. That inconsistency will hurt the economy. Switching gears, your mortgage rate, your interest rates on credit cards and car loans are based off of the 10-year treasury, which is more market driven. And the reason is more market driven is because 10 years is so far out from now that policy is unpredictable over the next 10 years versus short-term policy changes that are pretty predictable in the next 2 to 3 years. Take that as it may, given the current administration and environment. So do the markets even like Kevin Walsh? I would say the markets appreciate his opinion. And the nominee could have certainly been a lot more extreme. Any nominee the President of the United States chooses to serve as President of the Central Bank has to get approved by the Senate. Now, in terms of the economy is by and large on a pretty strong foot. I mean, unemployment has crept up recently, but the reality is corporate profits have been pretty strong. And as long as corporate profits remain pretty strong, it's unlikely that they're going to engage in mass layoffs, which will likely increase unemployment. So, we're pretty bullish on the year by and large. Right now we are in a deregulatory environment given the current administration, and businesses like deregulation. You may not like the current administration's policies, you may not favor him as a person, but the reality is companies like deregulation. Companies like it when there's an easier environment to conduct business in. Friends, now it's time for the breakdown. And in today's episode, we're going to talk about one of the 4 asset classes. And today we will talk about stocks as an asset class, aka equities. So friends, Very, very simple, and let's not make this any more complicated than it has to be. Because honestly, one of my biggest frustrations about Wall Street or institutional Wall Street is that they just create so many products and services and they blitz them at people that it makes it almost impossible to keep up with, the financial literacy. So on this episode, and on our show, on our platform, we're gonna break down all the jargon in digestible bits that even a 5-year-old could understand. So with that said, what exactly even is a stock? So let's pretend you start a lemonade stand. And let's pretend you are the only owner of that lemonade stand. In this example, there's one stockholder for that lemonade stand. And every time that lemonade stand makes a profit, where do the profits go? They go to the owners of the company. And in this example, if you have a lemonade stand with just one stockholder, whenever that company is profitable, that one stockholder will enjoy in the economics of the lemonade stand. It's literally that simple. We don't have to make it any more complicated than it actually is. Friends, if that lemonade stand grows from one lemonade stand on Main Street, middle of America, nowhere, and then grows and blossoms into this company that's worth billions and trillions of dollars just off of selling lemonade, and there's hundreds or thousands of owners at the table, right? It's no longer just one owner, right? It's no longer just one stockholder of the lemonade stand. You now may have thousands of owners at the table. And why is that? Well, because we're using the money from those investors to fuel the growth of our lemonade stand. And that's how we can get a lemonade stand from, sleepy Main Street, middle America to, a massive lemonade stand in every major city in America. It's that playbook. It's the OPM playbook, other people's money. So if you have a lemonade stand on Main Street and it costs you $10 for ice, water, cups, straws, lemons, whatever, sugar, and then you sell some lemonades and you somehow make $100 in profit. You now make $100 in revenue. You now made $90 in profit. That one owner could, in theory, pay themselves $90, or they can reinvest it back into the business to fuel their growth. And if you really want to expand your lemonade stand, you can bring on partners, use their money, and grow that lemonade stand. And that's the playbook. So when people say that they're going to buy stock in this company or that company, they're actually getting a seat at the ownership table. Now, if that company has 20 million other partners, hopefully that company is really, really profitable because you need to share in the economics with the other partners. But in those S&P 500 companies, all of them have valuations of into the billions, some of them even into the trillions. With just a handful of people at the cap table, you can see how owning stock in any one of those businesses can be impactful. Friends, in my humble opinion, the money is made in the private markets. It's so expensive for a company to go public and be traded on the stock exchange that the wealth is created by getting in early when the company is private, enjoying the appreciation until the company goes public. But even when the company goes public, if you get in early enough and you build a position that's, pretty significant, and over time the stocks appreciate and move up, you can create some pretty powerful wealth for yourself. And that's how this is done. Wealth is not created by buying a stock at $100 and trying to time it and sell it at 101. That's just not how we manage money in the professional setting. In the professional setting, first of all, everything is goals based. We will never make an investment related decision if it's not directly tied to one of your goals. So friends, professionals aren't spending their days day trading. That's just not what we do. The way we manage money is by managing risk, and you got to protect the downside. And the only way you can protect the downside is by 1, understanding your goals, 2, understanding your risk tolerance. If you make an investment today and tomorrow it goes down 50%, how do you feel about that? If you say, oh shit, I need to hit the sell button, then likely you are taking on too much risk. On the flip side of that, if you make an investment today and tomorrow your investment goes down 50% and you view that as a buying opportunity, that's a different conversation than the person who's in panic mode and wants to hit the sell button. Any professional investor will know this up front before making any investment related decisions. Again, every decision we make is purely based off of goals, risk tolerance, and most importantly, time horizon. So friends, the everyday person does not need to day trade. You do not need 5 different monitors. You do not need to follow what's going on in the stock market every single day. You do not need to have, an opinion on what's going to happen over the next 3 to 5 months, and you certainly don't need to know what are the trading multiples on your favorite stock. Here's what you need to know. What am I trying to accomplish in this lifetime? What's most important to me? What's the legacy that I'm trying to leave? How am I trying to accumulate this wealth and get it to the next generation without Uncle Sam taking 50% of that? These are some of the questions everyday people have, and I promise you the answer is not day trading, is not Forex trading, is not options trading, is none of that shit. It's financial planning. It's having a downside strategy, rebalancing periodically, understanding the risk that you're taking, understanding what's in your portfolio. So friends, thank you again for watching another episode of Invested in Us. We welcome you to join us across all social media platforms at NJK Partners, at Kevin Nunez NJK. Please visit our website for more information, njkpartners.com. Please sign up for our weekly newsletter where we take a deep dive into financial markets, economics and policy, community, all things financial related. And most importantly, friends, have a blessed day.